Let's get some global perspective. Now we have a very special guest joining us. Peter McGuire, CEO at XM.com from Australia, is joining us. He's on his visit to Mumbai, and that's where he's joining us from a studio. Mr. McGuire, thank you so much for taking out time for us. Could you first just tell us about the OPEC meet and what is expected out of there? I think it's this particular week that we'll get the decision. What is expected?
Yes, well, good morning, and thank you for inviting me on the show. More importantly, I think I'll be flying in there to Vienna in the next 24 hours, where the fabric of the meeting is quite interesting, how it'll, I think, play out over that additional 9-month cut to production. We're looking to really the Saudis taking the lead as far as the matter's concerned. I think there's been a very strong strategic alliance with Russia, being a non-OPEC producer, and more importantly, they want to continue these cuts. There's been compliance over the last 4 to 5 months, which has been adhered to. You're seeing numbers greater than 93, 94% compliance. So overall, the framework is that the additional cuts and that stay of that cut over that period of time, I think, is going to be very well received by the market.
Right, but do you think around $53, $54 where the crude prices are hovering around? What is the call over there? What's the upside, downside? I
think from if you're looking at WTI, you may see a couple of dollars extra over the next few trading sessions. I wouldn't be surprised. Then some profit taking may appear. We also need to consider that the US dollar's had a very, very solid washout over the last week and a half or so, and gold's had a nice move up on that. So when you take on board where the crude prices are, they may consolidate around these numbers or move a little bit higher. Let's see what happens in Vienna in 2 days' time. That's going to be the truth of the matter, and how it plays out is going to be very fascinating. Right, but just in terms of what happens to crude, do you expect it to go up further from here on, or around 60, 61 where it has been hovering should be the top? Well, I think it's probably got a little bit further upside. At this peak demand side, you've got the summer driving season in the United States and also Europe, so you've got more demand traditionally, and then you've got the opportunity that you may see weather outages as far as hurricanes affecting that the US geopolitical situation really doesn't move away. We've always got geopolitics, and traditionally in the Middle East summer that seems to ratchet up a little bit. So let's just see what happens over that the next few months, but I feel as though that they'll consolidate around this price. Also, it underpins in some ways the value of the IPO as far as Saudi Aramco. That needs to be considered. So there's a lot of major issues at the market at the moment, and we've just got to keep a very close eye on it all. Right. Till now, the focus, of course, was what happened to interest rates into US, how things are moving globally. What is your sense? Broadly, things are in line, or things have changed since the last we spoke? Well, I think they've changed a little bit, considering that in some ways the Fed was going to be a 3-rate rise year as far as 17, and from the situation at the present time, I'm not sure whether that's going to materialise. I think there'll be another rate rise, and the jury's out at the moment as far as a third one. So as each month rolls on, we've used 5 months nearly for the year. We're seeing some of those Fed Reserve presidents saying that it's a time to just let's see how the US economy is structured over that Northern Hemisphere summer as far as demand, inflation and so on. So at the present, I think again, the jury's out as far as those 3 rate rises, which in turn, if it doesn't materialise, I think there's going to be further downward pressure on the US dollar. Right. Just, if we just go ahead and look at, the changes in terms of what's happening into US. So one is, of course, the monetary side that you said. A lot has been spoken about the political side as well. What will happen? What are the changes that are coming in? Is that relevant for crude, or it's more important for base metals? Well, I think it's very important for crude, considering that the US is now producing about 9.3 million barrels a day, and the rig count seems to be gaining week on week when you look at those Baker Hughes numbers. So there's going to be more demand and more supply coming out of the US. I think over the next 12 to 18 months, the flexibility of workforce, and more importantly, as crude prices have ratcheted up from those lows we experienced at the start of last year, that's very, very, very mindful that it's a better return for these shale producers, and I think that that's going to increase their participation in the market. So that's going to be a very interesting input into the equation, how the US trades. Right.
What about base metals, about steel prices in China? We got some news flow yesterday that steel prices in China are going up, base metal prices are going up. What's your view on that side of the commodity?
Well, look, they've been fairly well sold off. We saw a big sell-off as far as iron ore and copper and a number of the other base metals over the last matter of months. And probably it's a bit of a time for, the market's probably having a little bit of a bounce from those lows, and it's not unusual. This time of year, as far as purchasing from the Chinese, we're well past that, the holiday, the lunar season going into, early Feb. So it's been a consolidation push, and I think you wouldn't be surprised to see a little bit further upside for some of those base metals. And again, as the US dollar comes off, that could add a little bit more horsepower to the value of them.
Right, and just in terms of base metals, you think a lot of the trade barriers that a lot of countries are putting, that itself is taking the prices higher, or at least not helping them go down?
Well, the trade barriers are very important, and naturally for their own countries. But I think the overall demand picture, as far as infrastructure and the building of a world. You've only got to have a look at the cranes as far as Mumbai is concerned in India, and have a look at what China. It's and all across Asia. I was in Kuala Lumpur over the weekend, and the construction there. Construction is really unheralded as far as steel demand and concrete and of course base metals. So that storyline I don't think is changing, and more importantly, the growing consumption as far as the world for all of these base metals and a growing demography as far as population base is just growing year on year.
Right. So what happens to this infrastructure space? You think that global growth will be higher, basically led by infrastructure spending?
I think so. I think that's pretty much what President Trump's trying to do, and certainly Prime Minister Modi. You look at the Eurozone, you look at all of these big players, they're all realising that they've got to spend considerable amounts of money on infrastructure. A lot of it's worn out. A lot of them are old, antiquated systems, and they need to be upgraded. There aren't many Singapores in the world when you think of their underlying or their underground transit systems are so magnificent to travel across, and they're new and exciting. So many cities across the world will have to adapt to those similar processes as far as mass transit, and that just shows you as far as the continuance of people moving from country regions to major cities, and Mumbai is a classic example of that.
Right. What do you do in terms of metal prices when you've already seen a one-year rally? So last year, or in the start of last year, prices of course were way lower. So yes. You saw that sharp rally. But now going ahead in base metals, in crude, such percentage rallies would not be possible?
Well, the markets get sold off and they go up in value, and we've seen that. I always say that lovely example being nickel, 52,000 a metric tonne. It hit, I think, at around about 09 or so, and it crashed to 9,000. So that just shows our viewers the price flexibility or price volatility of commodities. Who would have thought, if you put your mind back to 08 when crude hit 147, and then all of a sudden in 13 weeks it was around about $34 a barrel. So these markets are very dynamic. They wash out quickly, they ramp up in price quickly, and you've got so many components that go into price, from fundamentals to seasonality, and then you've got the traders ramping in with hedge funds and so on, building positions. So at the present time, I think that there's a lot of opportunity in those particular base metals, and traders have just got to keep a very close eye on them.
Right. In terms of, commodities, one of the big concern was what happens to commodity companies, the loans that they have taken globally, the bonds that are coming for redemption. You think that is now away with prices going up on a yearly basis? At least they can service those loans. So that part is behind now?
Well, it probably is. It depends on what price you're buying money at, and of course what how much it is to retrieve the particular commodity from the ground or deep in oceans, or dependent upon what commodity you're trading or producing. But if you put your mind and have a wonderful example as far as what it costs to pull a barrel of oil out from Saudi versus Venezuela, you'd be horrified if you were a producer to try and match price, because a lot of countries it's far more expensive to retrieve than what it is for these low-cost producers. For example, the Russias and the Saudis.
Right. Just in terms of global risk on. So, always people assume that if commodity prices are going up, it's risk on. But it could be opposite as well. So you could have commodity prices which is going up, but equity markets may not go up.
Well, exactly right. I mean, that's happened before, and we've seen those examples of the commodity super cycle. Markets can very much go sideways or just have large corrections, and the fundamentals are driving commodity side. That's not unusual. That happens in time, and it's just a work in progress. So I think that those sort of dynamics will certainly appear again. Traders have just got to keep a close eye on them.
Right. Just that, if commodity prices go up because of as well, so equity risk on would also continue?
Well, exactly right, and that's normally the state of play, and that's not unusual. So it's just a wait and see approach where traders see opportunity, and of course, producers. Sometimes you need to mothball certain projects quite simply because the price of the project to pull it out of the ground or retrieve it is more expensive than the current spot price. So it's one great thing about commodities, and that's the ones that come from the ground, they traditionally don't age. And, I'm not saying about grains, but, the iron ores and so on, they've been there for a long time and they'll continue to be there for a long time. So they can be retrieved at any date.
Right. Peter, what do you make of the demand dynamics in China? Most of the base metal prices are determined by either capacity or the buying in China. That seems to have started a little bit. Iron ore, has seen a very sharp correction. So from here on, what would you do with the base metals?
Well, it's a hard one to, as far as the trade is concerned, you've just got to be very mindful where your stop losses are and liquidity. The Chinese market, we're seeing, large rebuilding as far as not only construction, but more importantly, the warehousing and stockpile. So they're at record numbers. I saw those as far as iron ore, for their steel production, in warehouses, and I think that they were back to, multi-year highs in the sense of those stockpiles. So that's not uncommon. The Chinese are very strategic buyers. They've been able to buy at relatively low value and being able to build those stockpiles versus, when ore was at, say, $140 or $150 a tonne, it's a lot cheaper today.
Right. But do you see base metals strengthening from here on? There has been a little bit of correction. Do you see iron ore headed higher? Because, it's even fell into bear market territory. It corrected 20% from the highs.
Yes, exactly right. I mean, those markets do have big washouts, and it was probably overpriced there at some point. Many analysts are saying you're going to see a further retraction as far as ore over this year, price-wise. So as we sit here and we examine it, we're certainly considering where the US is playing as far as US dollar, what goes on as far as Chinese demand, and the appetite from those large consumers. So it's a difficult one to call. They've had a nice run up, the last couple of sessions, but to give a forecast, it's not that easy in consideration of all of the situation in China. Are we going to see further issues as far as their banking system? There's just a number of key components or drivers that we're keeping an eye on. So you might see a little bit higher as far as copper prices and so on, but I don't think you're going to shoot the lights out at $7,000 a metric tonne for copper anytime soon.
Right. So Peter, you were also saying that you don't expect rate hikes, two of those coming in from the US Fed this year, and you see if the dollar headed even lower if the Fed isn't that hawkish. So if the dollar is headed lower, would you then invest in gold? Gold in any case is seeing some signs of life. How would you trade that precious metal?
Well, if the Fed raises rates a further 2 times this year, which as each month rolls on, you'd have to be probably thinking, well, you might get one more rate rise, then that is certainly going to underpin gold. Gold's had a nice move up over the last week or so, trading sessions from those 12.25 lows all the way to 12.60. So there's probably more upside there, and let's just wait and see what happens with the US dollar and that US dollar index in the short to medium term. If you see another couple of percent wash out, back to that 95, 96 sort of level, then I feel as though that the gold market will probably have the capacity to move a little bit higher. It's just a bit of a wait and see at the present time. But the very many traders have got their eyes certainly focused on the fundamentals and what's happening.
So can you give us a range for gold per ounce in dollars? Where are you seeing it?
Well, I think it's got to be, that 1240 to 1280 sort of number. You might see a blowout to the upside. They've got analysts are saying that you're going to see, the $1,100. It depends on when we're talking as far as a timeline, but at the present, there seems to be more momentum to the upside than there is to the downside, and that's certainly been factored in as far as that US dollar. So that's where all the traders are looking. They're keeping an eye as far as dollar index and any surprises that are, mentioned from the Fed or, any... it just really, it's, from a surprise side, that'll make traders even more wary. Right.
Now, while all eyes are on the OPEC meet and the fact that crude oil has stabilized quite a bit, in the medium term, say if you give it 4 or 5 years, where do you see crude headed, given the kind of capacity addition we've seen in alternative fuel in China as well as India? Even the US is large on alternative energy. A lot of people are saying that soon enough, cars will only drive on electricity and nobody will even need oil. What is the long-term to medium-term outlook for oil?
Well, I mean, that's exactly right, and that's got to be the adoption of those new technologies and people to feel not only safe with them, but realise that that's, the price savings versus from an electric car to a petrol or diesel-driven car. There is certainly, a paradigm shift in people's perceptions and realities when they look at those new energies and what impact that's going to have on behaviour. It's a hard one to speculate. I think, the oil prices, those glory days of over $100 a barrel, I think are well and truly gone, though I'm not going to say they'll never happen again, but I think there'd be a very minimal chance for it to, see those sort of numbers. There's plenty of oil out there in the sense of production, and, the $40 to $60 price range possibly is the right sort of target. The more production coming out of the States, I think that's going to be a reality check. And, put your mind forward to this time next year. I'd like to be back here and going to another OPEC meeting. And I think that the prices will probably stay fairly range-bound over that year because, that 9-month cut, if that's what is materialised in the next, 24-hour, 48-hour meeting in Vienna, then that's going to wash into the market. And I feel as though that could form some sort of handbrake. So I think it'll probably stay around those sort of numbers.
Right. Peter, just a word on the meet that is coming up. What would be your base case assumption? Do you expect big production cuts?
Not necessarily big production cuts, but more importantly to just stay with this current, the status quo, roll it forward another 9 months. I think that the market is fairly engaged across that mindset. That's where they see, the process moving forward. It's hard to speculate. You'd have to wait till the next meeting in late November to get some indication of how 2018 is going to look. That spare capacity, if it's absorbed into the market, that will certainly move to that 5-year average, and that's what all those OPEC producers are trying to have to happen. So I think from where we're sitting at the moment, it's just a wait and see. If we don't see geopolitics, you don't see weather outages, then it'll be a very, I think, contained trading range over the months ahead leading up till that November meeting.
Right. And just in terms of global equities, year has been good so far. Most of the global equities, global commodity markets have done well. Generally, the year is not the same, so you expect some volatility before any upturn further?
Well, I think you've got to look at US dollar, you've got to look at Fed, you've got to see, it's been a very eventful year. I mean, if you put your mind back 6 months, you had the Trump winning the presidency, then you had the Dutch election, then you had, of course, what happened in France. So, and then moving there into, where Brexit sits, you've got the German election coming in September. So there's still some uncertainty in the market, and that creates, again, volatility. So there are some of the factors at play. Let's see what happens with US dollar. Let's see the rate rises. And globally, I think we need to see, an uptick as far as inflation, and that seems to be, again, one of the handbrakes moving forward. So the markets may be at a point in time that they're reasonably priced, and again, if you're a trader, you've just got to keep a very close eye on stop losses and, of course, the fundamentals.
Right. Just a word about complacency in any markets. Do you think that that is pointing out that there is a lot of free capital available, so any dearth of liquidity can lead to a big surprise?
Well, exactly right. I mean, there's you've only got to look at the bond rates, and people will, there's cash parked there, and it'll be, if you seek opportunity, and if opportunity presents itself, and you see those chances, then people are very quick to employ capital. So that storyline, I don't think is changing, and it will only continue. That's human nature. They're the dynamics of any market. People look for return and they look for opportunity. So that's where we're sitting at the moment. It's going to be an exciting year ahead, I think, for global equities, and more importantly, where the dollar goes, and some of those great commodity markets.